Okay, this is the first podcast for Chapter 15 in FIN 375 on transaction exposure. Unfortunately, I couldn't change the 9, and I also couldn't fix the spelling here in exposure. It shouldn't be exposure with a T, just exposure. All right, so when we are talking about foreign exchange, then we are talking about the measure of the potential for a firm's profitability, its net flow, or its market value to change because of a change in exchange rate. So a foreign currency can appreciate or depreciate in the future depending on where exchange rates go. An important task then for the financial manager is to be able to measure and manage this foreign exchange exposure. And we're going to look at some different ways that we can go ahead and measure foreign exchange exposure. In this chapter, we'll be looking at transaction exposure and translation exposure. Those result from accounting. And then we're also going to be looking at operating exposure, which will result from economics. Now, I have defined these three terms here. I will also define and talk about them more in this first podcast. Okay, so first of all, transaction exposure, then, as listed here in the slide, will measure the change in the value of an outstanding financial obligation that has been incurred prior to a change in exchange rates. However, the obligation doesn't have to be settled in the future until at which point exchange rates will change again. So what we'll see is that this type of exposure then deals with changes in cash flows that result from existing contractual obligations. Some examples of contractual obligations then would be the purchase or the selling of credit goods or services that are stated in foreign currency. So notice that each one of these examples is something that occurs in a foreign currency. The next one is borrowing or lending funds when repayment is to be made in the foreign currency. We may be a party to an unperformed forward contract, or we may be acquiring assets or accruing liabilities denominated in foreign currency. So those would all be examples of transaction exposures, contractual exposures. When we look at operating exposures, and that is the second topic in this slide right here, when we look at operating exposure, then these are also called economic exposures, competitive exposures, or strategic exposures. And what operating exposure will measure then is the change in the present value of the firm that results from the change in future operating cash flows that will change due to unexpected changes in exchange rates. So it's a very long way of saying that the value of the firm, again, we measure the value of the firm by discounting all its cash flows. Well, that will change in the future because exchange rates will change as well. And if it's an unexpected change in exchange rates, it's what we call an unhedged exposure, then that's going to affect the operating exposure. Okay, transaction exposure and operating exposure will again exist because of unexpected changes in future cash flow. When we look at transaction exposure, we are concerned with future cash flows that have already been contracted for. However, operating exposure will focus on expected future cash flows that might change due to a change in exchange rates in the future. So again, the key here is transaction exposure deals with already contracted for cash flows, whereas operating exposures focus on expected future cash flows that may change in the future. When we look at translation exposure, and that's the last one on this slide here, translation exposure, now we're going to be looking at changes that will occur in the owner's equity account because of the need to translate foreign currency financial statements from foreign subsidiaries. So if we have foreign subs that are dealing in, let's say, the pound sterling or the euro, they're basically put together in foreign currencies. We need to translate that back into the US dollar, and we're going to have a foreign exchange loss or a foreign exchange gain. And that's going to be plugged into our owner's equity section. So if it's a foreign exchange gain, it will increase our owner's equity. and if it's a foreign exchange loss, it will reduce our owner's equity. Why do firms hedge? Multinational enterprises or multinational companies have a bunch of different cash flows that they deal with, and they're very sensitive to them. So they're not only worried about changes in exchange rates, but they also have to worry about changes in interest rates and commodity prices. When we look at these three financial price risks, then these are the subject of what's known as financial risk management. So how can management go ahead and minimize the effect of changing exchange rates, interest rates, and commodity prices? That's what financial risk management focuses on. So firms will then attempt to manage their currency exposures through something called hedging. And hedging, then, the official definition is the taking of a position. It's acquiring either a cash flow or an asset or a contract that will rise or fall in value and offset a fall or rise in the value of an existing position. And that's sort of wording. So what is hedging basically saying? It's basically saying that if something goes down by this much and we protect ourselves, then the offset to how much this has gone down by will increase by that same amount, so that in the end then the loss and the gain on both sides will translate into a zero loss, a zero sum gain basically. So it's the offsetting of one transaction upon another transaction, so that we can go ahead and eliminate, or we can minimize as much as possible the potential foreign exchange loss that we can have. So hedging can protect the owner of an asset from a loss. That's really what the purpose of hedging is. However, it will also eliminate any gains, or it can limit the amount of gains that we have in the future if we hedge. So again, why do we hedge then? We hedge so that we can protect the company against adverse foreign exchange losses, and by doing that, what we give up then is some of the upside that's associated with that. Okay, so the value of the firm then is the present value of all expected future cash flows. This goes back to FIN 300 basically. These are expected cash flows, but we don't know for certain if they're going to materialize. So when we look at currency risk, this is the variance in expected cash flows that will arise from an unexpected exchange rate change. And a firm then will go ahead and hedge these exposures to try and go ahead and reduce some of the variance in the value of these expected cash flows. If we were to go ahead and to map it out in the normal probability distribution, notice how the unhedged position, which is in yellow, has much fatter tails. So that means that the risk of loss could be much greater. The hedged position has a much tighter probability distribution, so its tails aren't as fat as the unhedged position. That basically shows that we are narrowing what the potential loss could be if we don't hedge. And the value of the firm could potentially increase if we were able to go ahead and shift this probability distribution to the right. We would then have a rightly skewed probability distribution curve, which would really minimize any potential losses that we have here on the left side. Okay, again, continuing our conversation on why should we hedge, opponents would argue that shareholders are much more capable of diversifying currency risk than the management of the firm. How? Well, if a shareholder owns a portfolio of stocks where there are some that have foreign exchange risk, they could simply go ahead and sell those stocks and buy other stocks in firms that don't have foreign currency risk. Opponents also argue that it does not increase the expected cash flows of the firm. Hedging activities can also benefit management at the expense of other shareholders. That's what we call the agency conflict. And here the agency theory argues that management is much more risk adverse than shareholders. So if that's the case, they're going to go ahead and spend money to go ahead and hedge against potential FX or foreign exchange movements in the future. So they're willing to spend the money to minimize foreign exchange losses in order to protect their jobs. And then lastly, managers cannot outguess the market. So if we take the net present value of hedging and unhedging, then what we would find is that the net present value of that should come out to zero. So again, it's a zero-sum game when we hedge. Proponents, those in favor of hedging, say that it helps to improve planning capabilities. So it helps when we're doing the budget for the current and the next year. It will reduce the likelihood that the firm's cash flows will fall below a necessary minimum payment to make debt payments. So again, a company has to go ahead and make their principal and interest payments on their debt. If they don't do that, then they could be forced into bankruptcy, which wouldn't be a good thing. So foreign exchange then, by hedging, helps to reduce the variability in the cash flows. It helps us to protect our cash flow against adverse foreign exchange movements in the future. Any FX losses that we have are booked in the income statement. This is if they're unhedged. However, hedge costs and gains or losses associated with that are also in the income statement, but they're buried a little bit more in the operating or interest expense section. So it could be a little bit harder to find that as opposed to a one-line item that says foreign exchange loss. Management also has a comparative advantage in knowing what the actual currency risk of the firm is. So management knows what foreign exchange risks they should hedge. They would know it much better than shareholders do. One of the purposes of management then should be to go ahead and to hedge against potential adverse foreign exchange effects. And then lastly, management is in a better position to take advantage of these disequilibrium, or what the book terms temporary disruptive conditions in the market. So they can go ahead and do selective hedging if they take a view on where interest rates will go in the future. All right, when we measure transaction exposure then, transaction exposure will measure gains or losses that arise from the settlement of existing financial obligations. And these are and the terms of these will be stated in a foreign currency. Some common examples then of transaction exposure would be any receivables or payables that we have denominated in a foreign currency, or if we have funds that are loaned or borrowed in a foreign currency. Again, examples of existing financial obligations. If we look at the lifespan of transaction exposure throughout time, we can go ahead and summarize it into three different types of exposures, what we call quotation exposure, backlog exposure, and billing exposure. And a firm may go ahead to elect to go ahead and hedge against 1, 2, 3, or none of these exposures. So again, the first exposure is quotation exposure. And this is the time between quoting a price when we are trying to transact a business and then reaching a contractual sale. The backlog exposure is the time it takes to go ahead and fill that order from the time of the contractual sale till after the contract is signed. And then lastly, we have billing exposure, which is the time it takes to get paid in cash after we've booked that foreign accounts receivable. All right, foreign exchange transaction exposure can be managed by contractual, operating, and financial hedges. In this chapter, we're going to basically focus on contractual hedges. So in podcast 2, we will look at how you can hedge using a forward contract, money markets, and then futures and options. Operating and financial hedges will employ other techniques other than those mentioned above here, such as risk-sharing agreements, what we call leads and lags in payment terms, swaps, and other strategies. Again, we will be focusing on bullet point number 2 in the second part of this chapter. The term natural hedge refers to an offsetting operating cash flow from a payable arising from the conduct of a business. So an example of this would be, let's say that we have $1 million receivable coming in pounds sterling. However, we also have a $1 million account payable that we need to make in pounds sterling. Well, if you net those two together, we would have what's called a natural hedge. We would have basically zero exposure to the pound sterling. A financial hedge will refer to either an offsetting debt obligation, such as a loan, which we'll see in podcast 2, or some other type of financial derivative, such as an interest rate swap or or other types of financial derivatives. Okay, why don't we go ahead and stop the first podcast here, and we'll come back and we'll talk about hedging.